Alright, real talk. Imagine you're completely broke. Like, can't pay rent, lights about to get cut off, broke. And some dude shows up at your door and says, "Hey, I'll spot you the cash, but there are conditions." You're desperate, so you say yes. And that's when you realize the money was never really the point. So, here's the official story. The IMF is this big international institution with 190 member countries. Its whole thing is promoting global financial stability. Basically, a lender of last resort for countries that are in economic freefall. Country runs out of money, IMF swoops in, gives them a loan, helps stabilize everything. Sounds like a hero, right? But here's the thing nobody talks about. Every single one of those loans comes with strings attached. And not little strings. We're talking chains. The official term is conditionality. And once you understand what that actually means, you start seeing the whole system differently. To understand the IMF, you gotta go back to 1944. World War II isn't even over yet. But the US and its allies already know they're winning. And they're already drawing up the blueprint for the post-war world. About 730 delegates from 44 nations meet at a hotel in New Hampshire for something called the Bretton Woods Conference. Their stated goal was to stop another Great Depression from happening. What they actually did was design the entire global financial system from scratch. And right at the center of that system, the US dollar. Not gold. Not some neutral global currency. The American dollar becomes the world's reserve currency. Every other nation's money gets pegged to it. And out of that conference come the institutions, the World Bank, and the IMF. Now here's what's wild. The IMF's biggest shareholder, the one with the most voting power, is the United States. Which means the country whose currency runs the whole system also has the most say over who gets help and on what terms. That's not a coincidence. That's architecture. That's basically what's been happening to entire countries for the last 80 years. And the guy at the door, that's the International Monetary Fund, the IMF. Now most people have heard of it, but I have no clue what it actually does. And that's not an accident. So today, we're getting into all of it. The history, the receipts, and why this matters right now in 2025. Okay, so here's where it gets really gnarly. When a country comes to the IMF for a loan, they usually have no other option. The IMF doesn't just hand over the money. They hand over a document called a letter of intent. Inside, a list of things the country has to agree to do. This is the Structural Adjustment Program, or SAP. These programs almost always require the same stuff. Privatize your state-owned industries. Sell off water utilities, energy companies, telecoms to foreign corporations. Cut government subsidies on food and fuel, even if your population depends on them. Slash public spending, healthcare, education, it doesn't matter. Raise interest rates. Open your markets to outside competition. Let your currency devalue. And shrink your public sector workforce. Now, the IMF will tell you these are just sound economic reforms. Some can work in the right context, but the problem is the pattern. Wealthy countries that hit financial crises get bailouts, time, and flexibility. Developing countries, they get a list of demands. When things go sideways, the IMF says, you must not have implemented it correctly. That's a wild thing to say with a straight face. Let's look at what actually happened. Argentina, throughout the 1990s, Argentina did everything the IMF told them to. Privatized everything. Deregulated the economy. Pegged their currency to the US dollar. The IMF called it a model program. Then in 2001, the whole thing blew up. Unemployment hit 25%. The peso collapsed. 5 presidents resigned in 2 weeks. Argentina defaulted on $132 billion, the biggest sovereign debt default in history. The IMF called it unforeseen. Most economists called it predictable. Greece, 2010. After the 2008 global financial crisis exposed Greece's debt, the IMF came in as part of a trio of lenders. They called themselves the Troika. The conditions: brutal austerity, pension cuts, privatization of ports and airports. GDP shrank by 25%. Youth unemployment hit 60%. And later, a leaked internal IMF report admitted they had underestimated how badly their own program would damage the Greek economy. They basically audited themselves and said, yeah, we got that wrong. Greeks call that era the memoranda. That's not a compliment. And then there's sub-Saharan Africa across the 80s and 90s. Country after country, Ghana, Zambia, Tanzania, Senegal, got structural adjustment programs. Public health budgets got slashed. School fees got introduced where education had been free. State-owned farms and factories got sold off to foreign investors for cents on the dollar. And here's the kicker. In many cases, the new loans were basically just used to pay the interest on old loans. The debt was designed to keep renewing itself. That's not a rescue. That's a subscription service. Now, here's where it gets interesting for right now. Because nations aren't just sitting with this anymore. They're building XX, and we actually covered part of this in our dollar de-dollarization video. Go watch that if you haven't. It connects directly to everything we're talking about today. BRICS, Brazil, Russia, India, China, South Africa, plus a bunch of newer members, is actively building an alternative financial system. A development bank with no structural adjustment conditions. Trade deals settled in local currencies, cutting the dollar out entirely. China's Belt and Road Initiative, whatever you think of it, is essentially a competing loan program with its own terms and its own agenda, and central banks around the world. They are hoarding gold at levels we haven't seen since the 1960s. Why? Because gold can't be sanctioned. It can't be frozen. It doesn't need a swift transfer. It's just gold. It's the oldest form of financial self-determination there is. And nations are reaching for it again because they know if you don't control your money, you don't really control your country. So, look, the IMF is not a cartoon villain. It has real economists doing real work. It has genuinely prevented some complete economic collapses. And in recent years, it has softened. The word inequality shows up in their reports now. That's something. But the core architecture, the voting structure, the dollar dominance, the conditionality playbook, that's still there. And as long as the system is built so that some nations write the rules, while others have to borrow just to survive, the leverage exists. And leverage gets used. The real question for the next decade isn't whether the IMF will reform itself. It's whether the nations that have been on the receiving end of these conditions long enough will build something that actually works for them, and whether whatever comes next will be honest about what it is instead of calling a leash a lifeline. This history wasn't in your textbook, but now you know. And knowing is the first move. Yo, if this video just changed how you see the global economy, do me a solid and smash that like button. It genuinely helps more people find this content. And if you're new here, welcome to Finance Untold. We don't do surface level. Hit subscribe and turn on notifications so you don't miss what's coming next. Drop a comment and tell me which country's story hit different for you. Argentina, Greece, Africa. And if you want to go deeper on everything we talked about today, the dollar, gold hoarding, de-dollarization, I've got those videos linked right here. Go watch them, the pieces connect. Trust me, stay curious, stay skeptical. I'll see you in the next one.